In this week's show, I'm going to share with you two ideas that are going to be very relevant to you at this stage of the property cycle, whether you're a beginning investor or an experienced investor. First of all, with the finance strategist, we're going to discuss some top tips to get the banks to say yes more often in this changing landscape. And I'm going to explain why not all land is created equal and how to choose those areas that are going to outperform in the future. And then I'm going to share 3 success tips as I answer one of your questions.
Are you interested in property investing, success or money? Well, you're in the right place. This is the Michael Yardney podcast, where each week you'll learn a number of new ideas regarding success, property investment and money in 20 minutes or less. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, who has once again been voted Australia's leading property investment advisor. That's the 4th time he's won a similar award in the last 6 years.
As a property investor, this stage of the cycle isn't as much fun as the last couple of years when things were booming. If you're like many investors, you're having difficulty getting finance, whether it's to start your portfolio or grow it. And capital gains isn't assured, so where do you buy? At the end of this show, I hope I'm going to share with you a few things to help you have some clarity on what's ahead. Firstly, I'm going to have a chat with leading finance strategist Andrew Morrims about some top tips to get the banks to say yes more often in the changing finance landscape. Just recently at Wealth Retreat, when I was with a group of high net worth property investors who already had large portfolios, they were all lamenting how difficult it is to get finance in the current landscape. But if you're a beginner, you're probably finding it just as hard. So what we're going to discuss will point you in the right direction. I'm also going to explain why not all land is created equal. And then I'm going to answer a question from one of my listeners about my top success tips. There's going to be lots for you in this show, so welcome. And by the way, if you're considering getting involved in property development or renovations, I'm starting work on my annual Property Renovations and Development Workshop to be held in October. It's a 2-day workshop. It's Australia's longest running advanced property workshop. Why not go to realestateworkshop.com.au, find out all about it, because I'd love to spend 2 days with you in late October. realestateworkshop.com.au. Now, let's get on with the show. We're obviously in a credit squeeze at the moment, but it all has to do with how the banks are assessing our serviceability. And if you're like many property investors, the banks are not looking as favourably on you today as they did a couple of years ago. So today I want to have a chat about how to secure more finance today with finance strategist Andrew Morrims from Intuitive Finance. Hello, Andrew.
Hi, Michael. How are you?
Good, thank you. Now, I know it's a question you asked a lot at the moment because the banks are giving us a hard time, but can you give us some tips as how to make ourselves more attractive to the banks and how to get the banks to say yes?
Yeah, no, absolutely. We recently penned an article just with the 10 tips, so I'll probably take you through that. So I guess the first one, and I think still today it's underutilised, but seeking professional advice, making sure you have a team of specialists on your side. So a great team of buyers advocates like the Metropole team, the right finance experts that are dealing in this every day and living and breathing it, the right accounting and tax structures and things like that. Making sure you've got a team of specialists around you is imperative. The harder it is, I think now it's even more imperative.
Interestingly, some people will say, hey, that's self-serving. You're starting off saying, I've got to see you, I've got to see Michael's team. I agree with you, Andrew. I think today you need somebody to help you through the maze. The Royal Commission has shown us that the banks are not on your side, the real estate agents aren't on your side. So I like the fact that you put that at the top, and I'm not at all ashamed to say that.
Sure. Yeah, no, I think it really is, whilst it might be the case, it's just showing that there's specialists and then there's the other people at the moment.
Okay, so the banks are now looking at you more carefully, Andrew. They're looking at your income, but they seem to be scrutinising your expenses more too.
Absolutely. Yeah, look, most of the lenders are asking now the categories they're out to about 13 to 15 categories of expenses, and some you might not have considered, or you might just pay on a daily, weekly, monthly, basis, quarterly, whatever it is. But you're being asked to justify them. You're being asked to articulate them, and you're being asked that just to make sure that what you actually spend, what you're declaring is what you actually spend. And we do see people that come in and just say, it costs me $3,000 a month to live. And then we look at their bank statements and outgoings that month was $6,000. Make sure you can articulate it. When we ask you to break it down, have an idea. Do some averages. We've got lots of people and lots of clients that do some averages. That's all we're after. It's never exact, but you've got to be able to justify and articulate your living expenses.
So one of the things you should do when you're going to your finance strategist or the banks is to actually understand what your income and your expenses are, have your tax returns done, have all your paperwork ready, because they're looking at it much more carefully. But Andrew, currently the banks are not lending as much for interest-only terms, or they're charging more. Is it a worry to go to a principal and interest loans?
No, it's not. I think principal and interest for some people in the right area and with the right outcomes, depending where they're at, whether they're starting or whether they're near the end, paying principal and interest is not the enemy. It might cost you a little bit more in cash flow, but if you can afford that, then why wouldn't you do it? It can, in many cases, be the difference between securing the loan at a higher level or getting less. It's almost gone full circle when now principal and interest loans are more attractive and you can service more over interest only. It's funny how the world changes in only a short amount of time, Michael, but that's where we're at the moment.
Sure, but some people still can get interest-only loans, can't they?
Yeah, absolutely. Interest-only lending is still a very important part of the overall property investing strategy. So it's not that bad. You will generally pay a little bit more. So for interest-only, we always do a quote between principal and interest only, but you might pay a bit more in interest rate, but it'll still be cheaper for your cash flow. So you have to be able to, again, validate what's more important. Is it the actual rate or is it your cash flow? And for most people trying to build a portfolio, it is the cash flow.
Sure, I guess it depends on what stage of your investment career you are, because if you're getting to the point where you're now starting to lower your loan-to-value ratios, no one would argue with the principal and interest payments.
Absolutely. Yep.
We've always said that real estate property investing is a game of finance with some homes thrown in the middle. So part of that is having a right finance strategy and having buffers. Do people understand the power of that when you see them?
I still a little bit surprised at how little people know about offset accounts. I think they're one of the more powerful tools in any property investor's arsenal. So having an offset account on very much your home, if you still have a home loan, but even having them on the right offset and the buffers is really important, that you're not paying interest on something you're not using. So setting up your buffers correctly, having offset accounts, they're a really powerful tool in your arsenal as a property investor.
What it means is that you're putting your money back into the bank, not paying interest on it, but you don't have to ask for it if you want it back, if you need it. That's giving you an opportunity to buy yourself time.
Yeah.
Also, you've got to buy the right properties. The banks are a bit fussy at the moment about what properties they're going to lend on.
Yeah, look, the banks have always been fussy about more higher performing properties over different. So if you buy a unique property like a studio apartment or something like that, they've always been at a lower loan to value ratio because they don't fit the general market. So a house, a townhouse that mums and dads and people, families, starters and downgraders all want to live in are still highly popular. But going for speculative things or chasing the next big trend is going to be scrutinised as to why you do it. So buying the right property is absolutely paramount.
Right. Also, we've both spoken about the concept that smart investors don't just buy properties, they buy themselves time to see themselves through. And part of that's the concept of having a buffer in place.
Yeah, correct. Look, buying and selling property, as we know, is expensive. The stamp duty costs for every state, and then selling is... So you don't want to trade in property. You want to buy it, you want to hold it and let it do its thing over the long term. So making sure you've got your buffers in there. And as a rule, we want... If you say in the long-term average property cycle is 7 to 10 years, and we've spoken that may not be the norm moving forward, but if you say that is, we want at least half that cycle margin in there depending on the client, depending on their ability to increase their income, depending on how well they can justify their expenses, but making sure they've got at least half a cycle so we can enjoy some capital appreciation, I think is paramount. And in some cases, we might want more, and in others where they're really high income earners and looking to really grow aggressively in the short term, that might be a little bit less. So it's really horses for courses, but you must have a buffer.
That means you must have a finance strategy. So going to the bank and asking for the biggest loan you can at the lowest interest rate possible isn't a finance strategy. You'll buy a property and then you're going to get stuck.
Yeah, absolutely. So that's, you don't want to just rate chase. Rate is very important, but time to give your property the opportunity to grow is more important, I would argue.
And sometimes saying no is the right thing. I know I've made more money by saying no to opportunities than yes to opportunities that seem to be the next shiny toy. But no one likes getting knocked back by the bank, Andrew.
I think human nature dictates that none of us like being told no, Michael. But sometimes no is not the enemy. Again, sometimes no, it's no for a reason. And in fact, we always try and talk to our clients about it's not no, it's just not now. So it might be a timing thing. It's never, no, don't ever speak to us again. But in a tightening market like we've got at the moment, the reality is there's just some people who have done really well in growing their portfolios and things like that just can't. The regulators have looked across the board and said, we just need to slow this thing down. And so it's not no because you've done a bad job. It's just no because the rules have changed.
It's also sometimes that people have got unrealistic expectations. They think they can buy a property every year because of what they read in the magazines. But some of those stories seem a bit unbelievable. They've either got super high income or they've bought dud properties, or possibly when those people in the front of the magazines got their loans, they didn't really declare everything. There was ways of getting loans that probably they overcommitted themselves a bit.
Yeah, that's a really good point. And that's some of the scrutiny now where lenders, you would put down, you just state what your expenses were, what your other properties were. And look, there are some people that do the wrong things. That's going to be corrected by a new regime of comprehensive credit reporting that's going to be implemented, I think, sometime in the next 12 months. And no one has really spoken about this, so it's a bit of a first. So your listeners are hearing it for the first time. But what banks are going to do effectively is share their information, share the credit card limits, share the loans, share all the data that a client will have at other lenders. So there can't be any misreporting or misinformation. So again, the scrutiny is going to be even more. But that's what they've decided is going to knock out a lot of those people doing the wrong thing, because actually the people doing the wrong thing that has the impact on people like us, Michael, that want to do the right thing and want to grow our portfolios progressively and steadily.
Well, we don't want the property market to crash here like it has in other countries overseas where there was loose lending criteria and not a sounder banking system. One of the things that underpins the value of our investment properties and our homes is the fact that we've got a sound banking system. So while none of us like these changes, in the long term, it's good for us.
Yeah, it's going to give us a stronger market, and boom-bust cycles are never good for anyone. Sure, if you enjoy the boom, that might be good, but that probably sets you up to fail at some time in the future. And then if you buy just before the bust, then you're only going to have that bit of bias against, I knew it wouldn't work for me or something along those lines.
So we were working through a list of ways of making yourself more attractive to the banks, Andrew. You also wrote in your blog about the concept of getting your properties regularly revalued.
Yeah, I think it's really important that at least your property doesn't go up and down every 5 minutes. It doesn't go up and down weekly. It might in reality, but it doesn't in terms of what we want from a long-term perspective. So getting your properties revalued every 2 to 3 years, I think is and it can just be an appraisal from an agent. It can be something from if you've got a buyer's advocate, just getting a reappraisal from them. And then if we think the opportunity is there to increase your buffers by another property, absolutely getting your portfolio revalued by the bank valuers just makes sense.
And having a plan in place is important. We spoke about that really, that you actually need a property strategy, an ownership structure strategy and a finance strategy. You've got to treat it like a business.
Absolutely. Now, we probably could have started with having a plan in place, but we finished with it because I think it's really, really important. If you don't know where you want to get to, how are you going to get there? If you're just buying property for the sake of buying it because, your next door neighbours did, you're sort of setting yourself up to fail. If it's about your wealth creation and having a plan to grow X amount of properties to give you a lifestyle that you want to enjoy in the future, then that's really important. And then you need to be fluid in your thinking there because there's going to be times where it's going to be easier and you might be able to buy that one a year. There's going to be times where you might have to sit on the sidelines for 1, 2, 3, 4 years. We don't know how long this cycle will last for, and people will just have to sit it out for now. But having a plan and being willing to rethink and readjust all the time is vital.
That's important, but actually having a plan that works is even more important, because if you've got the wrong plan, if you've got your ladder against the wrong wall, every step you take is going to get you a step further away from where you want to go. And I guess that takes us right back to the beginning. Have a team. Have somebody that you can discuss your plan with. If you're the smartest person in your team, you're in trouble. Andrew, there are some great hints there on how to make yourself more attractive. And if people want to find out more about you, intuitivefinance.com.au, and you regularly blog on Property Update. Thanks for your time, Andrew.
Pleasure, Michael. Thank you.
Are you wondering who you can turn to for independent and unbiased advice? Metropole has helped beginning investors buy their first property. Experienced investors add to their portfolio, and sophisticated investors manufacture capital growth by becoming property investors. The team at Metropole Property Strategists have been involved in over $2 billion worth of property transactions, creating wealth for their clients, and they can do the same for you. It's a great feeling having the independent team at Metropole helping you formulate and implement your wealth-building property investment strategy. Arrange a time for an obligation-free chat at metropole.com.au. Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset moment this week, I'm going to answer a question from Jamie from Leichhardt, New South Wales, who asked me to share a couple of my top success tips. Now, there's so many of them, Jamie, it's not easy, but let me share 3 today. And the first one I learned a bit late in my career was to model success. Because I was wondering, is there a shortcut to success other than trial and error? I thought I had to do it all myself. And there absolutely is a way. The smartest way is not to reinvent the wheel or try to start from scratch. Now, I know at school you were taught not to copy, but to succeed in business or investing, you should copy. However, we call it modelling. And when I learned this from one of my early mentors, from Tony Robbins, it made a huge difference to my success and the speed of my success. So what you've got to do is model successful people, learn what they do. Also model successful businesses, ideas, concepts, model successful property investment strategies. Find somebody else who's achieved what you want to achieve and then learn how they've done it, but also how they think and why they think and what they do. And to help you, get some mentors, because if you stand on the shoulders of your mentors, Jamie, you'll be able to see a lot further. My second tip is, most people overestimate what they can accomplish in 12 months, but they underestimate what they can accomplish in a decade. Now, you've probably heard that before, but it is worth repeating because it is so important. Most people overestimate what they can accomplish in 12 months. They think they can do it all, and they can't. But they underestimate what they can accomplish in a decade. Now, if you think about it, it wasn't that much more than a decade ago that the iPhone wasn't around. They only came in to Australia in 2008. It wasn't that much more than a decade ago that Facebook started to become popular as well. So there's a lot you can achieve over time once you get traction, but it takes time to get that traction. The third tip I'll share with you today, Jamie, is a bit about the law of opposites, which one of my early mentors taught me as well. He said to be successful, find out what most people are doing and do the opposite. And he explained that if you think about it, most people aren't successful. Most real estate investors are not successful. They don't develop financial independence. Most small businesses go broke. So most people don't succeed. The reason they don't succeed is sometimes because they don't take action. But if they do take action, they seem to take the wrong action. They seem to have the wrong property strategies. Now, there are 3 pretty simple tips, Jamie, when you boil it down. Sure, there's lots more strategies and lots more tips I'm going to share weekly in this show, but thanks for your question, and I hope those 3 success tips will help you as well.
If you're enjoying our show, please subscribe on iTunes. You'll find us there as Michael Yardney Podcast, and we'd really appreciate it if you would leave us a review. When you do, we'll read it out on the show. By the way, Michael creates a lot of content he only sends out by email, which you can have with no obligation. So also visit michaelyardneypodcast.com and subscribe to his commentary there.
Now, here's an interesting thought. Not all land's created equal. So what am I on about? Well, some suburbs will always be more popular than others. Some areas will always have more scarcity than others. You know, they're going to be near the water, near the beach, near the CBD. And over time, some land will increase in value more than others. Now, of course, these are the sort of properties that property investors should target. And that's where they're going to get above average capital growth. So for you to outperform this stage of the property cycle, when the markets are a bit flatter, let's work out now how you can find areas that are going to outperform the averages. For as long as I've been investing, there's always been the argument, regional Australia versus capital cities, inner suburbs versus outer suburbs. And sure, there are always exceptions. Some better performing regional areas have clearly exhibited more capital growth than some underperforming capital city suburbs. And some high growth outer suburbs have grown faster than some demographically challenged inner suburbs. But overall, for strong, stable, long-term capital growth that outperforms averages, the inner and middle ring suburbs of our big capital cities are the place to invest. Now, let's be clear, that wasn't always the case. I remember property researcher John Lindeman explaining that around the time of Federation, the turn of the 20th century, the price of country properties was equal to, and in some cases even greater than, the cost of similar properties in the city. But over time, this slowly changed as we moved from an agrarian society to an industrialised nation. So after the Second World War in Australia, with the arrival of a huge number of overseas migrants, they preferred to live in the cities, in particular Sydney and Melbourne, and this led to larger increases in the value of capital city properties over regional Australia. I guess it's much the same today. The majority of the migrants who are coming in, and that's one of the big drivers of our population growth, more than making babies, the majority of the migrants want to live in our capital cities because that's where the jobs are. And this trend is unlikely to change in the foreseeable future, with few significant decentralisation initiatives in the pipeline. The government's always talked about fast trains and moving departments here and there and out to the regional areas. That's not where people want to live. All this means is that investors seeking long-term capital growth should really only be investing in our larger capital cities. Okay, so whereabouts in the capital cities? Look, about 10 years ago, I read a study from Macquarie Bank showing that, in general, properties closer to the CBD and closer to the water increased in value faster than those further from the CBD and further from the water. And in general, this trend's been confirmed by other studies, including the Australian Housing and Urban Research Institute. And you'll actually find the graphs and the figures of this in a blog on Property Update called Not All Land's Created Equal, where you can see the truth that while property values grow in the outer suburbs, they don't grow as much as the inner and middle ring suburbs. So in the past, that wasn't the case. In fact, house price growth was equal-ish around the outer and inner suburbs. But today, the difference is that property values increase higher, closer to the CBD. Now, this brings around a whole raft of social arguments. The process of gentrification and rising prices has locked a whole generation of younger people out of the inner city and middle ring areas. And this is likely to create a gap that's only going to widen over the years. Now, leave the discussion of the remedy of this for the politicians and town planners. But the conclusion for people like you and me, for property investors, is if you want to own the type of property that's going to outperform the averages, the middle and inner ring suburbs are the place to be. But it's the same all over the world. Go to any major city, London, Paris, Vienna, Los Angeles, and you'll find that the wealthy people tend to live within, 10, 15 minutes drive from the CBD or near the water. And why is this so? Cynics would probably say because they can afford to. And in part that's true. But in general, the more established suburbs with the better infrastructure, the better shopping, the amenities, tend to be closer to the CBD and the water. And that's where the wealthy want to live. It's where they can afford to live. It's where they're prepared to pay a premium to live. So one of the significant changes that's occurred in Australian cities over the last 50 years, and which has pushed the value of inner city and middle ring suburbs up, is what's called gentrification. Interestingly, this wasn't a deliberate planning policy, but resulted from a set of demographic changes that occurred in most capital cities around the world. When I was young, and I was born in the 50s, in the early 50s, in the 50s and 60s, the inner suburbs of Melbourne and Sydney, say 5 kilometres from the CBD, were relatively dense, mixed-use, working-class suburbs with a mixture of small terrace houses, pubs, and a lot of factories. That's where the industry was. Accommodation in these suburbs was relatively cheap. That's where migrants were attracted to, and they brought with them cultures like delicatessens and pizza shops and cafes. Over the years, manufacturing moved from these inner suburbs to the outer suburbs, and many of the migrants and the inner city blue-collar workers also relocated to buy big, larger homes on sizable plots with front and backyards. And with the exodus of industry and migrants and many workers from the inner suburbs, that made way for what we call gentrification of our inner suburbs, where initially house prices and rents were cheaper than in other places. They weren't the place that the wealthy people wanted to go. Later, our changing demographics with declining household sizes, in part because we're getting married later, we're having fewer children, meant that these inner small suburban dwellings and apartments provided ideal accommodation for this expanding cohort of professionals who worked in or close to the CBD. So gentrifiers were initially drawn to these inner suburbs because of the diversity of jobs, education opportunities, lifestyle, and the trend still continues today. And more Australians are swapping backyards for courtyards and balconies. Today they're called hipsters, but the bottom line is that the argument's going to keep raging. Some are going to continue to recommend the outer suburbs because they're cheaper, they're more affordable, the yields are a little bit higher. And all this is true. But remember, over the long term, rents tend to grow more substantially in landlocked suburbs where demand is the strongest and capital values increase more. So in my mind, there's no question that the best locations to invest for the long term, for capital growth, and that's how I believe you should be investing, are the inner suburbs of our major capital cities where the jobs are, where most of the people want to live, and where there's no land available for release. So there you have it. Not all land is created equal. So one of my strands of my 6-stranded strategic approach is to have a high land to asset ratio. And that doesn't mean have a lot of land. I'd rather you own a sixth of a block of land under an established apartment in one of the better inner ring suburbs of Melbourne, Sydney, Brisbane than a whole acreage way out in the suburbs. Well, that's almost it for another show. But before we go, I'd love to read out a review I received on iTunes. I enjoy getting them. We've had 92 reviews in the first year. Thank you so much. And they're all very positive, which I love to hear. This one was left by Gavin from Sydney, and he said, "A really insightful warts and all discussion from Michael. I really enjoy these podcasts as they're so empowering. Keep up the great work." Gav, I am going to keep up the great work. And to anyone who sends me a review and puts it on iTunes, I'm more than happy to give you a copy of one of my books. Just send me an email, tell me you left the review, and I'd be happy to give you one of my books. By the way, you'd be doing me a real favour if you could spread the word through Facebook or Twitter, social media, and email. Tell a friend or two about the show, because the great reviews I get, the fantastic rankings I get, all the new subscribers I get, keeps me invigorated to keep passing on this information. We're going to have some challenging times ahead in the next year or two in the property market, but I'm going to help you get through the maze because I've done it on many cycles before. So thanks again for joining me. I look forward to having a chat with you again this time next week.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from listening to this podcast, please leave us a review and we'll read it out on a future show. Just go to michaelyardneypodcast.com/review and it will take you over to iTunes where you can enter a review and let us know what you think. We'd really appreciate it. If you don't already subscribe on iTunes or on your Android phone, you'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes or a transcript of the show, head across to michaelyardneypodcast.com. Watch out for our show next week. You learn some new ideas about property investment, success, and money in around 20 minutes.